Hello, welcome back to Laptop Trader channel on YouTube. My name is Philip and I'll be hosting this month's presentation. I'm here to share my trading experiences and give back to the stock trading community one video at a time. This channel is mainly for new or recovering traders who've had problems, but all are welcome. Again, our monthly videos cover markets, stocks, ETFs, stages, technicals, fundamentals, market cycles, trade risk, trade entry, trade management, trade exits, and how to create confidence by putting the odds in your favor. I believe in being my own trader and investor and not leaving this up to others to do it for me. Any questions? My contact is laptoptraderphil@gmail.com. This video is for information only and should not be considered investing advice. Caution, trade at your own risk. Most stock traders lose money, especially day traders. Please protect yourself at all times. Any stock suggestions are up to you to decide if that is appropriate for you. Good luck and God bless. Start now by educating yourself on how markets work and finding out what is right for you. Invest in yourself and then invest in the markets. So our November laptop trader agenda. Okay, so normal business. We'll just review the markets since last month. We'll get back to some basics of trading. We're going to take a look at risk management and position sizing, setting stops and targets, and share sizing, trade selection and analysis, some of the basics of entering a position, trade management, raising stops and when to sell, which is one of the toughest parts of trading. And then we'll have some charts at the end that kind of meet my criteria going forward. So I've got some examples, some chart examples at the end for you. So let's review some of the markets. So again, this S&P 500 chart, it's a 5-year monthly chart. So each candle or each bar is 1 month. And again, we're up again this month. October, another new high, another closing high for October. So that's like 6 months in a row, 7 if you count this bottoming tail back in April. So very continued higher on a monthly basis in the S&P 500. So still bullish. It may be extended, but it's still going up. On the weekly chart, so when we look at a different time frame, now we're looking at the weekly chart. We had 4 weeks ago, we had kind of this scary week where we had quite a bit of selling that week. That week was down 2.5%, but the market has recovered over the last 3 weeks. We had a similar event back here in August where we had kind of a down week, and then the market continued higher. So we're still in an uptrend overall for the overall markets. Then we've got the daily chart where, again, this was that scary day. This was a Friday. I believe the market was down, 2 to 3% on that day, which was really high for a market. And then it's slowly but surely recovered, kind of gapped up here, went sideways, gapped up. Now recently there's been a lot of gaps in here. I don't like that because this shows there's still a lot of volatility, just based on these prices. But we did make a new high on Wednesday, and we gapped down and sold off on Thursday. And the market actually gapped up but sold off on Friday. So there's still some volatility there. It doesn't mean the market can't go down, but it also doesn't mean the market can't continue to go up. So when we look at these multiple time frames, we kind of get kind of the big picture, right, with the monthly chart. And then we can kind of zoom in and see, okay, what are some of the details of that move higher or lower? And then we can decide from there. So why is this important? Why is the overall market important? Well, simply because most stocks, not all, but most stocks will follow the market up or down. And then it's up to you to decide if this individual stock or security is a good value or a good decision at this time, right? Some stocks will be on their own page, or some sectors or some industries will be on their own page, and they may continue to go up even if a market is going down, and vice versa. Here we can look at the overall NASDAQ ETF, and we can see pretty much the same picture over the last 6-7 months since April. Still in a major uptrend on a monthly chart. And weekly on the NASDAQ, we made a new high this week on a weekly basis. So both these major markets that we watch are still in overall uptrends. And on the daily chart, again, we see, this warning bar a couple weeks ago on a Friday, and then since then it went sideways, gapped up, gapped up, gapped up, gapped up, made a new high, and then gapped down, left a red bar, and then gapped up here and left a red bar. But that's still a higher high and a higher low versus the previous bar. So right now the bulls are still in control until they're not, right? Kind of innocent until proven guilty. Pretty much the same pictures with the Dow Jones average market. If you trade any industrial stocks or Dow Jones stocks, that is still in a major uptrend since April also. And then we've got the small cap index, the Russell 2000, which is a much different looking chart, really a gigantic range between this 163 area on the bottom and around the 246, 245 area on the top. We recently in October broke out of that range going into November, so that is also up 6 to 7 months and just made a new high. The difference between this and the other charts is this is making a new high from a bottom, right? From the bottom of the range, so to speak, to the top of the range. So that is much more likely to lose momentum and kind of sell off. Not that it will, but you just have a different looking chart there in the small cap stocks. Doesn't mean there's not good opportunities now in small caps, but that would be an area of caution, I would say, going forward. If you're in small caps, watch out, because if this index does start to sell off, that could easily drag down other smaller cap stocks that you may be trading or may be invested in. Again, the transportation average is also a little bit different looking chart, similar to the Russell 2000 small caps. Different in the fact that we actually have some higher lows on this chart on a monthly basis, where you've got a low point, a higher low point, and now this other higher low point since April. But again, it's moved from the bottom of this area kind of to this area up here where there's resistance all across the top of that chart. And you can see the size of these candles or these bars. Where the range is fairly large range, and now the range is contracted or gotten smaller, and that's usually a sign that you have that momentum slowing, that there could be some selling in this area of the market. So again, that'd just be kind of a caution. I think with those two markets, we're looking at more of a neutral market there, and this Russell 2000 and the transports, where they could, if there is a crack in the market, I think that's where you would see selling take place first. All right, let's get on to the rest of our agenda. I don't want these videos to get too long, and I don't want you guys to lose any focus. So let's get into our topics, okay? So let's talk about risk management and position sizing and how this can really help you. This really made a difference in my trading over the past couple of years, as especially since 2022, where I didn't really adjust for the risk of 2022 and the bear market of 2022. It really caused me a lot of heartache and a lot of stress, and didn't have a good year. But position sizing, okay, is one of the most important factors in your success or failure, in my opinion. If you risk too much, it may be detrimental to your account and your financial future. This can cause you to blow up your trading account, lose sleep, and be stressed if you are oversized. So start small and grow with your experience in trading. Again, this may take several, market cycles, may take several years for you to kind of get this internalized, but I think it's worth internalizing. My personal max position size guideline is no more than 10% of my account size. So if you had a $100,000 account, that would be no trades greater than $10,000. If you have, a $1,000 account, you wouldn't want to take a trade higher than $100, okay? So it's just a guideline, it's a ratio, it's something that I have found extremely helpful. And by the way, this should probably be much smaller if you are new or have had issues in the past with losing money. But I chose the size because even if a company gaps down a large amount or stops trading or goes out of business, my account can recover from an overall 10% loss. Think about companies that were here today and gone tomorrow, like FTX, or Genesis, or Enron, or Silicon Valley Bank from a few years ago. It happens, so be careful and think. This is why most financial advisors recommend against investing or trading in individual stocks or cryptos or commodities. It is riskier to trade in individual names. But we can mitigate some of that risk with position sizing. So, in my opinion, it's okay to take trades or positions in individual stocks. You just have to watch, how much you're investing in those particular companies. Because if you go all in and something happens, that's going to be very detrimental to your account. All right, how about setting stop orders and targets and share sizing? By setting stop orders and share sizing, we can further reduce our risk in any one position. If we were to look at a chart and determine we do not want to lose any money below a certain point in case of the unexpected, we can do that with a stop loss order. If we combine rule number 1, position size, with this rule, we can clearly manage risk. For example, if we risked $1,000 on a trade, we could further reduce that risk to $50 with a 5% stop loss. This loss limit only allows you to buy so many shares, called share sizing or risk sizing. This protects us and allows us to stay in the game. We can take many trades and only lose $10 or $20 or $50 on our losing trades. If you use these rules and you trade individual stocks, you will have losing trades. It is not uncommon for successful traders to only win 40 or 50% of their trade positions, right? Similar to a successful baseball player. They may only hit 250, but they may hit a lot of home runs. When it comes to our upside targets, we can calculate some sort of potential risk to reward ratio, and you want to ideally look for the most upside potential regardless of the time frame. The smaller the time frame, like a 15-minute chart, the less you should expect to make. The stock can only move so much in a day. Well, if we go up in time frame, then we can expect a higher ratio or a bigger move over a longer period of time. I will say this too, that's not printed. A stop loss will not protect you from a gap down, from an overnight gap. And that's one situation where you may have a 5% stop loss, but you could still take, a 7% loss or 10% loss, because a stop loss will not protect you against overnight gaps. So that's kind of where rule number 1 also helps. Position sizing helps with that too. So let's talk about basics of when to enter a trade position using technical analysis using charts. I just listed on here 3 that I really like to look for. One would be a cup and handle breakout formation. Another one I really like is a long base or a consolidation and then a breakout above that area. And the third one I like would be a pullback in an uptrend and a buy setup, or what I call a 3-bar turn. So those are 3 kind of setups I'm really looking for, and I really prefer the one in the middle personally. And then there's also 3 specific candles or bars that I like to look for, such as a gap down reversal and a bottoming tail candle or a shakeout, and a wide range and or an engulfing candle or a wide range bar. If you combine the wide range bar with a gap down reversal, that's also very powerful. And then there's also specific locations and time of these setups on these charts that also matter, using multiple time frames for the best opportunity. And I'm looking for the best risk to reward. Specifically, I am looking for tight prices or price contraction in low volatility areas called a base, and for prices to expand from that area to the upside. And you can spend many hours looking over many charts to practice our skills, right, for free. Then you can start to take small positions until we get comfortable and familiar with the process. Position size is relative to our experience and to our account size. So if you have, let's say you had a large account size, but you have very little experience, you would still want to take a small position size. We can also combine some fundamental information to look for some longer-term opportunities, such as growth in revenue, sales, growth in earnings, what type of industry is this company a part of, and the current theme that's in the market that's really pushing stocks higher, right? So the current theme in the markets would be AI computing, quantum computing, data center expansion, and probably semiconductors would probably be there towards your top 4 themes at the moment. So these are areas we want to look for opportunities. Now let's talk a little bit about trade management, raising stops, and when to sell. This is probably the hardest part of trading, as it becomes more individual based on your experience, your personality, your position in life, how much time do you have to commit, and how many positions that you hold. It can be very difficult to hold through the inevitable pullbacks in price for the potential larger gains. All stocks and markets go up and down and back and forth. For me, as someone who has a career and other responsibilities, I do not day trade, and I set my positions up using my broker's platform to save me time in this business. One of the best tips I can give you is position size became super important to my trading plan and my style for my experience level. It just gives me so much freedom to take smaller positions and see how they play out first, and then later they either work or they don't. Many of the positions do stop out, but at a small loss. And the ones that work, I usually add to later on when they have proven themselves. Many times they work and grow over 100 or 200%. And this really gets my account moving in the right direction. I'll say it again. Position size is critical, in my opinion, and helps me sleep very well. When to raise stops to break even or in a profit situation. This invites the concept of a free ride or a free trade. I do this all the time, and it really helps with reducing risk even further and letting your winners grow. If we raise our stops too soon or get nervous, there is a good chance you will be stopped out at a loss or break even and not make money. That's okay. Just as when I enter a trade, I like to look for my 3 action candles or bars to help me know when to raise my stop. So I'm not only looking for, the bottoming tail bar or shakeout bar or, a wide range bar or some sort of gap down reversal bar. I'm also looking for these when it comes to raising my stops, because that gives me a clue that, that was kind of the point. It's where buyers actually stepped up. Now I can really know that's a great time to raise my stop. My second rule is anytime a position is up significantly, like 25% or more, I will raise my stop to break even or higher. Then from there, I can look at daily or weekly charts to look for pivots or levels that the price of the stock should not violate. It's a fairly simple process, but it does take a lot of trades and practice to get comfortable with. In fact, this recently happened to my trade in Hood or Robinhood. I was stopped out only to see the stock move up significantly higher. I was stopped at 123.75, and my initial stop loss was 117, so I had raised that stop. And this week it closed at 146.78, so that was kind of a tough trade because I should have had a profit and I had either break even or a small loss, simply from raising from 117 to 123.75 based on some chart level. Anyway, this is probably the most frustrating situation you can have and not easy emotionally. But it happens, and you must find a way to deal with it. One way I deal with it is, again, smaller positions, so the loss is not as depressing, right? So you're going to have to plan how are you going to lose. It's very important in trading. How do you plan to lose? Because you're going to have losses, you're going to have stops. Stocks aren't going to go to target or whatever. Okay, continue when to sell. When to sell is easy when you have a stop loss in place, whether that is for a loss or break even or for a profit. It's done for you after you place the order with your broker. A much more difficult thing to do is determine when has the stock or company hit a top or plateaued. In this analysis, I do not find fundamentals very helpful at all. In fact, many times stocks will hit a top on great fundamentals and then sell off from there. Technically, we can look at charts, usually higher time frame charts, to see where a stock looks extended or overbought. Or is there a level from the left where a stock had previously sold off from? Now, this is a bit subjective as what looks extended can become more extended or overbought, and so it is not easy. But I find higher time frames can help with this. The easiest thing to do is keep raising your stops over time to coincide with the charts and or use moving averages to align with your stops and targets, and this way you should catch most of a move up in price. For example, some traders may use a 50-day moving average as their point in price and time to take profits if the stock is in an uptrend and pulls back below that point. They exit at that time to protect and take some profits back off the table. This is the part of trading that can be quite different and subjective from different traders' styles. So that's just an example. But over time, you should be able to figure out something that can and should work for you consistently. All right, let's take a look at some charts. So here's just a, this would be a monthly 5-year chart of Robinhood. So we can see where it IPO'd or became a publicly traded stock, had an earnings event, sold off, and then went into this long base, or this long stage one. Then it started to move up slowly, and then we had kind of this wide range igniting bar after we had this bottoming tail bar. So to me, that would be a significant event, right? It shows that buyers are starting to come into this stock. And the volume increased here, went sideways a little bit, moved up. Okay, then we had kind of this pullback over price and time over these 3 months. On this third month, it left a bottoming tail on heavy volume. And from there, since April of this year, it's just ripped higher along with the market. And so that's an example of, a good entry point would have been back here somewhere, maybe on this bar, or after this pullback into a moving average. Would have been a nice entry point there. And that also coincides, if we look to the left, with kind of the tops of this area. I kind of discount these topping tails a little bit when I go to enter something like this, but if you look right across there, let's just take this line. If we had entered here around the $54, $55 area, you can see that in this short period of time, over about 6-7 months, you could have almost tripled your money. Okay, so that's kind of where we're looking for an advantageous entry point, an area of low volatility, an area of price contraction or a base, and then we look for price to expand out of that base. This would just be a daily chart of Robinhood. Again, I had a stop in here around 117. I raised it to 123.75, and on this candle right here on October, I think it was 22nd, this is the candle that stopped me out, and from there it kind of went back up. So that's what can be very frustrating about trading sometimes, but it happens and you just have to take the loss and move on. All right, let's get to some possible, just some generic opportunities. I'm not saying these are right for you or not, but I just picked out a few to give you guys some other examples. Okay, so again, here's a company called Journey Medical. Symbol for that company is DERM. You can look that up for yourself. But here we had, again, an IPO where the stock started becoming a public traded company, and which is very common with IPOs. They call them, is very common for them to become public and then sell off. That's not uncommon at all. Not all of them do that. Some do become IPOs and just kind of go up from there. But this one sold off after the IPO, made a low in 2023, I think May of 23, and then from there it's kind of started to move up, right? So now we have evidence that buyers are starting to get interested from this point of price and time. And you can see the volume increase too, right? We also had a volume spike on this bar, which led to a sell-off over 4 or 5 month period. And then from there, at least on this chart, you can see it kind of put in this base, but it's a wide range base from, if you look from the top of these candles here, you can just, if you were to draw a line right across that chart, you can see top of those candles, and you draw a line here, you can see the bottom of those. It's just this wide range, volatile base, right? So in my opinion, not a great area to enter a trade. So we just watch and wait. Well, then we get some more evidence that the stock wants to move up. We get this nice move up over, about 3 or 4 months. Again, these candles are fairly wide in range. So that means when you have that, that means you're going to have a greater or a higher stop or the potential for a larger loss. So what I like to do is I like to wait for something more like this where the candles consolidate. Well, here they start to consolidate. And in September, we had this nice, tight, narrow range candle. And then from there, price moved up over that area. So for right now, I kind of like that as a potential entry point in this company. Closed the week and the month at 812. Had a little bit of volume support there behind that. But there's several cautions about this company. One is it's a small cap company. Two, it doesn't trade a great amount of volume, signaling to me that it's a more speculative or riskier trade, right? So you can see it only trades about 165,000 volume. I like stocks over in the millions of volume, but this is one I would consider just because of the look of the chart. Now, what would our upside potential be? Well, it'd be more back in this area towards this top, this high point. So a potential target could be $10 to $12. Okay, if you were to enter here, 812, potential risk to reward would be 12. Potential downside would be maybe give it $1 risk. So you could get a potential 3 or 4 to 1 trade on something like that. Again, just an example, not a suggestion, but that's kind of what I'm looking for. I'm looking for a narrowing in range, a narrowing in price, and then taking advantage of the move out of that area. This is what it would look like on a weekly chart. It looks even better, in my opinion, on the weekly chart because you can see this range is more defined, right? So this narrow bar on a month is the same price action here on this weekly chart where you see this much narrower range here and then the expansion out of that area of contraction. So if we look back in time, again, we can see we've had other bases, but they're kind of wide, kind of volatile, right? Can you guys see how that's kind of back and forth? And then over here, the candles are fairly wide. We get a little bit of narrowing here in price, and then it kind of gets volatile again. And now we've had a nice period of time over about 8 weeks of this narrowing range. To me, that's a much better risk reward opportunity because our stop loss can be tighter and our reward can be potentially greater in that situation. So that's all I wanted to show you with that chart. We also have on this last bar what I call high volume close or increased volume on the close. Similar to here too, this bar had a closing green bar and nice high volume on the close. So that's something to note too. Again, here's just the same chart I put on some of my chicken scratches here where I try to draw for you what I'm seeing. I hope this makes sense. But here you have this wide range, this wide base range. Okay, this is a weekly chart. And then you can see the range narrowed. See that? How it went from this wide range to a more narrow range. But again, these candles to me are still too wide. So I wait and see. And now we have a much tighter range, much narrower range. And then we have this igniting wide range bar out of that range to the upside. So that's kind of what I like about that chart. Here's a daily chart showing the same company but in a daily chart. And you can just see where this range is at. Right? It just goes back and forth, up and down, and then it kind of tightens up. See that? How it tightened up right here over this week, and then we have an igniting bar on volume. Sideways, We actually have in this example, right, a bottoming tail, we have this gap down reversal bar and then an inside bar to that. I would consider this a buy over this area. It's probably like 825 or something like that. Again, here's the same chart with some more of my chicken scratches showing the base. We have that igniting wide range bar. We've got this gap down reversal bar, a bottoming tail, which shows buyers are clearly stepping up in that area at that time. Two cautions on the stock though. If this was in your comfort zone, right? Caution: there is earnings on November 11th. Many traders choose not to buy stocks into earnings or hold into or through an earnings events because earnings are typically and historically a very volatile time for individual stocks. So that's a caution on that. Also, this is a small cap stock with lower volume, right? It's only trading in Wall Street terms, it's trading probably between 100 and 200,000 shares a day. That's very low volume in Wall Street terms, okay? But if that's an opportunity that you like, I think that's a decent area to consider. All right, next chart. This is a company called Optimizer X Corp, symbol OPRX. Here we can see the monthly chart. We can see it was in an uptrend, then it went to a downtrend, and then went into this long period of consolidation for pretty much 2 to 3 years. And then we had here on this earnings event, we had a high volume close with a little bit of expansion in price there from the previous 4 months. See how tight these bars are? We had an all-time low. And over 4 months, this was very tight price action, then expanded up out of that area. That's a big clue. High volume close, expansion up from a base, right? It didn't expand down. If this was going to go down, it should have went down, but it went up. So that's a clue that this price should continue to go higher, and that's what it did. This is what it would look like on a weekly chart. Again, you've got this downtrend, and then all of a sudden you get this high volume close on earnings, and then it pulls back, gives you a second opportunity to enter right here on this pullback or this buy setup here. Okay. Here's an example of Palantir Technologies, right? Look at the long base on Palantir. Multi-year base, expands upwards out of that base. Look at the volume increase across here, and then we get this nice run up in Palantir. So, quick question to you guys is this a stock now, where it's at now? Is this something that you would buy here? Right? And for my trading plan, no way. I would never buy this here. It's just too extended. It's not an opportune time to get involved. The candles are wide range candles, and it's too late in the move. I'm looking for something back here. I'm looking to buy the base or buy out of a base, and let the stock market do the work for me. Okay, that's what I'm looking to do. Here's a company called Celsius Holdings, symbol CELH. This company is in the food and beverage space. You can see it as fairly long uptrend, right? And then we had a kind of all-time high here, and that sold off. And you can see the momentum slow to the downside, right? You can see these large, wide-range candles up here, and then as it comes down in the selling, in the stage 4, we get the candles get smaller, indicating slowing momentum. Then we get a high volume close. Not a great looking candle there, still a topping tail candle, but then after that, price moves up, moves sideways for 2 months, and then moves up again. So what does this tell you? This tells you that the sellers are kind of no longer selling. Prices hit a bottom. Prices moved up. Now the evidence tells us that price should continue higher from this point. Okay, and the month after that, we had a nice tight inside bar showing a consolidation or a quick base. And from there, price expanded again to the upside. So this is a nice little uptrend here, right? And now we've got 2 months with smaller candles. And now I'm looking to get involved in here. And the thing I like about this chart is if we can get another month of tight price action, I like this. I would like to see this move up on a low risk to reward basis, right? Low risk, high reward, for this to move up to the $80 to $100 area, right? So that'd be very nice risk to reward trade potential. Again, just an example. Again, here's where I drew some targets, right? You can kind of see this this stage 4 into a stage 1. You got this high volume close. Then we've got a wide range bar igniting out of that area sideways. And then we have this new base forming over here, new potential base. So that's what I kind of see on the chart. Here's another one, Hive Digital Limited, symbol HIV or Hive, right? So we can see the move up in Hive, the pullback, the move up, creating this kind of this plateau over here, sometimes called an M top, right? Where you have a high point, pulls back, makes that high point, and then sells off immediately. So this would be, kind of like this big stage 3, stage 4, back to stage 1. And look at the volume. Look at the lack of interest in this company until you can see the volume starting to pick up. Look at the massive increase in volume in this company. This is the type of volume that I'm looking for. 38 million shares traded, right? So this is really right in my wheelhouse. These are stocks I like. Look at that tight price action there over 3 months, even 4 months. And then from that base, price moves up, right? So now we have evidence that buyers are in control. Price is not moving down. It's starting to move up. So that's one there I really like. Open Door Technologies. Again, very similar looking pattern in Open Door to the last one. A little bit different in the fact that it made a high point, sold off, went sideways, started to move up, and then we get this wide range red candle, and that was the beginning of the end for that. We get the selling, selling, selling. It goes into a long multi-year base, a low point, and from that low point to here, the stock has made a nice move up in Open Door Technologies, symbol open. Look at the volume on that, right? 300 million shares traded. That's big money moving into that stock. That's not mom and pop traders. Okay, here's another one. Koppen Corp, symbol KOPN, right? Similar pattern, similar look, right? Stage 3, stage 4, sell off, stage 1 base, multi-year base. High volume close, kind of pulls back a little bit. On this, if we had entered here, even 4 months after that high volume close on this green narrow bar, it closed at $1.28. Today it's at $3.46. That's a significant gain, right? That's a very significant gain percentage-wise. It's about 158% move from the close in May of this year to this month. $1.28 to $3.46 per share. Again, look at the volume in January this year, that high volume close. Look at the stages, right? Stage 4, stage 1 base, early stage 2 uptrend. Also, I want to show you guys on this chart, if we drew lines across the tops of these candles, you're looking at resistance, you're looking at the ceiling, and over here, we can see this candle this month break out of that ceiling and close above that ceiling. So this is kind of where we're looking for the ceiling to become the new floor. I've talked about that in other videos. I think that's kind of what you're seeing in this company. Anyway, in closing, I think that is enough for this month. I hope this video is helpful in your success as a trader. The bottom line is these opportunities are in the market every day and every month. The only question is, will you do the work to find them for yourself, and will you have the discipline to take advantage of these opportunities? Good luck, Laptop Trader, and I will see you next month. Again, caution, most stock traders lose money. Please protect yourself at all times. Nothing discussed in this video is trading or investing advice. This channel is for informational purposes only. Please seek qualified help if you need help investing. Again, my contact is laptoptraderphil@gmail.com. Hello? How can I help you?